Welcome back. Our next guest is a longtime Canadian strategist who believes investors should not expect the S&P 500 to exceed the high it set in February. One of several pairs trades he recommends is going short on the S&P 500 while going long on stocks outside of the United States. Joining us now is Martin Roberge, North American portfolio strategist at Canaccord Genuity. Martin, thanks a lot for joining us. Let's start with your big picture view, and one of those is that there's more opportunity in equities outside of the USA than there is inside. Correct?
Yeah, there's a tectonic shift underway where global equity investors are kind of looking at the U.S. equity market and realizing that you're dealing with really high concentration risks with AI-related stocks accounting for about 40% of the index. At the same time, you've got overvaluation risks. As we mentioned in a report this morning, the earnings yield, bond yield differential has nearly collapsed to zero. So you really need lower bond yields to get the index going. And lastly, you're also dealing with an overvaluation of the US dollar. And the last times we had this trifecta in the past was like right at the peak of the Nifty 50 bubble in 73, 74, and then around the tech bubble and the tech bubble peak in 2000. So it's nothing wrong against the underlying companies, but it's just an understanding that you're going to be probably capturing currency appreciation in global markets, international markets, along with the fact that you have more valuation headroom before you hit a valuation wall.
Do you see the U.S. stock market collapsing? I mean, that's the impression that viewers might get when they hear you reference the sell-off of 1973 or the tech wreck of 1999, 2000.
No, not at all. Like you cannot compare the two situations. The first in 73, 74, like valuations were way more extended. Same in 2000, and also like the dot-com bubble was smaller when it comes to the GDP impact, while the AI bubble, the AI mania or the AI cycle is going to have probably more short-term productivity benefits than we had through the dot-com cycle. So no, it's just that you're really swimming against further US dollar depreciation potential. We looked at US dollar bear markets, and on average, it's a 20% correction. We're down 10% on the US dollar. Like I'm talking about the Dixie, like the trade-weighted dollar. There's probably another 10% to go. Historically, the euro and the yen has appreciated on average about 30%. So yeah, you can go to the U.S., but you're going to be dealing with still U.S. currency risks. So why not like continuing moving away from currency risk and towards like those currencies that will provide you with some appreciation, such as the Canadian dollar and the yen and the euro.
Okay, so we'll show viewers one of the pairs trades that you recommend, and I think you've explained it well, so we don't need a lot of discussion on this. We'll move on to some other trades as well. But the first one Martin has recommended is going long an ETF of non-U.S. equities. That is VEU in New York, and going short on SPY in the U.S. That of course is an S&P 500 ETF. So it's going long on non-U.S. stocks, going short on U.S. stocks. Speak to it very briefly, Martin, and then we'll move on.
Yeah, it's the trend. It's the trade or trend that has been going on year to date. Like we've seen non-U.S. stocks about up like 10%, while the U.S. equity market is flat. Since we still see another 10% in U.S. dollar depreciation, well, that trade has probably another 10% to go before we close it. So it's just like what we believe is left to U.S. dollar depreciation. That's why we like that trade.
Okay, here's one that will require a bit more explanation. Going long on U.S. software stocks as measured by or as reflected by an ETF with the ticker symbol IGV, and going short U.S. semiconductor stocks by going short on an ETF with the ticker symbol SOXX. Explain this one to us.
Yeah, it's basically within the AI cycle. You want to start moving away from the picks and shovels and move towards the AI users, those that are developing ATIs and APIs. So you want to move away from hardware to software. For me, again, nothing is wrong with the semiconductor companies, but we saw through Q1 results that the guidance, when you account for the guidance, top line growth will be slowing down over the balance of the year, while we have the opposite for software companies. And quite frankly, this upturn in relative sales strength is a reminder, or reminds me of the same dynamic we had in 2000. If all you remember, the multiplexers, this technology breakthrough allowed telecom companies to send way more data through their copper wires. Like, I think that was GDS Uniface back then that was building those multiplexers. So when there's a technology breakthrough, usually you have to go for the users rather than the architects. And this is exactly where we think we are in the cycle.
Okay, and the last pair trade is a way to invest in the U.S. healthcare sector, going long on U.S. medical equipment makers. The ETF there is IHI, and going short on U.S. pharmaceutical companies. The ticker symbol there, PPH in the U.S. Explain this one to us, Martin.
Yeah, two sectors within the healthcare sector. As you know, we had last week President Trump signing another executive order on the most favored nations, which is like saying basically that U.S. drug prices must come down and be competitive with global drug prices. So we don't know how much of the gap will close. We know it's a big gap, but medical equipment makers are totally isolated from drug prices. And as we know, there's a post-pandemic catch-up in hospital construction, in certain medical surgeries as well. So, and on top of that, medical equipment makers are huge beneficiaries of a weaker US dollar because they import a lot of primary components from global markets. So we like medical equipment makers relative to drug stocks.
Martin Roberge, thank you very much for this conversation and for an explanation of three pairs trades that Martin likes in the market right now. Martin Roberge is North American equity strategist at Canaccord Genuity.